So hi everyone, it's Wisdom Trader right back here. In this lesson, we are going to be looking at Japanese. So once again, in this lesson, we are going to be looking at Japanese candlesticks, and this is an ultimate guide to candlestick patterns. So before we go any further, we want to first study the structure of a candlestick right here. So a candlestick is made up of the body, made up of the upper shadow or the wick, and then a lower shadow or a lower wick. It's also made up of a range. Okay? So when you look at the diagram below, of course, you can see that we have the upper wick right here. Then we have the lower wick right here. Then we have the range that is all the way from the high to the low. Then we have the body of the candle that is the red part of it. Then the same to the opposite candle. So normally the green candles, normally bullish candles or the white candles, and then the bearish candles are normally red. Okay, that is just the default settings in most cases. So in short, we have said that a candlestick is made up of the body. Candlestick is made up of the body. It is this green part here, and then it has what we call the upper wick, has the lower wick, then it has the range all the way from the high to the low. Okay, so we are still look at the structure of the candlestick, and then we say that the upper shadow of the wick, this is one which shows the highest price traded at a given time frame, and then the lower shadow of the wick, and this one shows the lowest price traded at a given time frame. Okay, then the body represents the difference between the opening and the closing price. Then the range shows the difference between the highest and the lowest prices traded. Okay, then if the closing price is higher than the open price, the candle formed is what we call the bullish candle. So we said if the candle opens low and it closes high, this is what we call a bullish candle right here. And then if the price opens high, then it closes low, this is what it forms, what we call a bearish candle, or a candle for a price which is going downwards. Okay, so if the closing price is lower than the opening price, the candle formed is a bearish candle. So we are saying if the price opens low, then it closes higher than the open, that one is what we call a bullish candle. So a bullish candle simply means that the price increased, and then a bearish candle simply means that the price decreased. So the bearish candle always opens high, and then it closes low. Okay. So we're still looking at the structure of the candlestick. Long bodies indicate strong buying or selling pressure. The longer the body is, the more intense buying or selling pressure is. Okay? This means that either buyers or sellers will be stronger than the two control. Okay? Short bodies imply very buying and selling activity. So bulls mean buyers, and then the bears mean sellers. So when you hear bulls, it means buyers, and then the bears mean sellers. So when you hear bearish or bullish, so bullish candlesticks are the whereby the price increased. Okay. For example, if the price opens at $2 and then it closes at $6, this one is a bullish candle. But if the price opens at 2, then it closes at 1, that one is a bearish candle because the price decreased. Okay. Then we said that in normal cases, in default conditions, a bullish candle is always white, and then a bearish candle is black. And then bullish candle is green, and then a bearish candle is red. Okay, and then the recap is we have the upper wick, then we have the lower wick, then we have the body of the candle, then we have the range, which is all the way from there up to the swing low. Okay. So the same thing with the bearish candles. So we are going to be looking at the candlestick patterns. After looking at the structure of the candlesticks, we want to look at the candlestick pattern. So a candlestick pattern is a combination of two or more candles, and it helps traders to anticipate the strength between buyers and sellers, or it helps us to anticipate indecision between buyers and sellers. So candlestick patterns work best if used with other trading tools like the chart patterns, the indicators, and connect levels, support and resistance, and then very many other trading tools like support and resistance, supply and demand, then technical indicators and chart analysis, market segment, stuff like that, which we shall be seeing in the future. Okay. So we are looking at candlestick patterns. And the first candlestick pattern we are going to be looking at is what we call the doji. Okay. So we have different types of the doji. So just get the names as doji, D-O-G-I. The types of the candlestick patterns. For dojis, we have the standard doji. Then we have a four-price doji. We have what we call the gravestone doji. We have a long leg doji. And then we have what we call a dragonfly. Okay. So a doji is a candle that has zero or almost a zero body. Okay. For example, if a candle has a very small body, then it has wicks for the upper and lower shadow. That one becomes a doji. So we said it has almost zero body or it has a small body. For example, this one has no body in most cases because you cannot see the body. Okay, it is almost having a zero body or it has a very small body. Okay, so these candles suggest indecision, or they can also suggest balance between buyers and sellers. So neither buyers nor sellers are fully in control of the market price movement. Okay. So a doji that occurs in a strong trend implies the weakening of the dominant force that resulted in the trend. Okay. So what are we trying to mean? For example, if we have a clear uptrend, so if we have a clear uptrend like that one, okay, and then at the tip here, we get a doji. Get a doji like this one. It means that the dominant uptrend, which has been happening in the market, he has lost control. Okay, it has lost control, or we are saying that the pressure which pushed the price up is reducing or is weakening. That is what it means. A long-legged doji has long wicks in both directions, implying strong balanced pressure from buyers and sellers. So we are saying that a long-legged doji is a doji which has long wicks in both directions. For example, it has in the upper wick is long, then the lower wick is also long. So we are saying that it implies that there is strong or balanced pressure from both buyers and sellers. Okay, this is what we call a long leg doji. Like to see it right here. So we are still looking at these dojis, and we are saying that the dragonfly doji implies dragonflies here. Dragonfly doji implies sellers control the market for most of the trading period, but buyers manage to push the price back to the top. So it is this is a dragonfly doji. So the dragonfly doji shows that the price went down, okay, to this level. Then the buyers were able to push the price right back up, and then they're performing this long lower wick. Okay, this one shows that buyers managed to push the price back to the top. Okay, then a gravestone doji implies buyers control the market for most of the trading period, but sellers managed to push the price back to the bottom. So this is a gravestone doji right here. It's normally like this. So the price went up around this level, and then the sellers were able to push the price right back to close at this level down. Okay, there's a gravestone doji. So a tradition or a standard doji and a long leg doji reflecting decision between buyers and sellers. This is a standard doji, okay, or the tradition doji, just like a plus sign. Okay, like that. That is what we call the standard doji. So gravestone and dragonfly are generally clearer, stronger indicators that are posed in the steepening into the push the market in the direction of the wick are away from the body. Okay. So these are the clear types of the dojis. We have what we call the standard doji. It looks like this, just like a plus sign. Then we have a long leg doji. Long leg doji has a long lower wick and a long upper wick. This a long leg doji. Okay, long upper wick and long lower wick. Then we have a 4 price doji. This one is also a clear incision between buyers and sellers. Then we have a gravestone doji. Then we have a dragonfly doji. Okay, so you cannot maybe be able to cram all the names, and then you can simply categorize them all as dojis. When you see them, you can be able to interpret. Okay. So we are looking on this live chart. We want to see if we can be able to spot some dojis. Okay. So the word dojis we have seen before. Okay. So we have been able to look at the standard doji. We have looked at the long leg doji, then a 4 price doji, then a gravestone doji, then the dragonfly doji. This type of doji, the 4 price doji, normally occurs in the stock prices. Okay. So when you look at the chart here, we want to spot some dojis. Okay, so when you look here, we have this one here. It has a body, yes, I agree, but it is a long-legged doji. As a doji is supposed to have a small body, or it is not supposed to have a body at all. Okay, we have another long-legged dojis here. Okay, they saw incision, the price was moving high. Here the price was moving high. Then after forming these dojis, the price decided to come back down. Okay. So we have other dojis. Doji. We have this one here. This is also a long leg doji. Okay. So we are still spotting other dojis. We have a doji here. We have a doji there, long leg doji, and then a standard doji. Okay. We have this standard doji here. Another doji we have here, standard doji. This one here is a standard doji. We have the standard doji also, or it can be a long leg doji, but it looks more of a standard doji. We have the standard doji right down here. Then we have another doji right here. We have another dojis. Okay, so dojis are always so many in the market. We have a doji here. We have a doji here. Okay, then we have a doji here. So those are the dojis. Okay, so almost when you look at the price, or when you look at the chart here, it shows that every time we form dojis, the price tended to change direction. So here the price was moving high, but after forming these dojis, it showed that the current pressure which has been moving the price higher and higher has come to an end, and then finally the price down. Okay, so when you look here from this doji showing that there's going to be a change in the direction of the price, and then finally the price had to reverse. So here we saw a doji here, but nothing much happened. Here we saw dojis, the price continued high. Here we saw dojis, and then the price was pushed downwards. Okay, so like that. That is how we spot the dojis in the market. So when you spot the doji, then it is a confluence level. Of course, you will take the trade in the direction of that. So once again, these are the dojis. We want to spot them. We have these ones here. We have some dojis right there. We have some dojis right here. So we have some dojis right here. And we have some dojis. This is also a doji. Then we have some doji right here. Then we have another doji. Right here we have some doji. Then we have doji. Every time the doji forms, we have seen that in most cases the price changes its direction. Okay. So the second candlestick pattern we want to look at is what we call the hammer. Okay, it's called the hammer. So when we look at the chart, that is how the hammer looks like. Simply here, that is how the hammer looks like, or right here, how the hammer looks like. Okay. So a hammer is a candlestick with a small body, a long wick protruding below the body, and a little or no wick above. So we are saying that a hammer, it normally has a small body, okay, and then it has a long wick, and then at the top here, the wick is always little or the wick is always on there. Okay, so in the top, we normally have a wick, or we normally do not have a wick at all. Okay, so the color doesn't matter, it is still a hammer. Okay, the hammer can be blue, sorry, it can be green or it can be red. It is still a hammer, irrespective of the color. So it is very similar to a dragonfly doji, and the primary difference is that the dragonfly doji will have essentially no body, meaning the open and close prices are equal. Okay, so this is the hammer, this is a hammer, then this is also a hammer. The color does not matter, it is still a hammer. So when a hammer appears at the bottom of a downtrend, okay, its long wick implies unsuccessful effort by buyers to push the price down and corresponding effort by bulls to step in and push the price back up quickly before the period closed. Okay, so we are saying that when we see a hammer on a downtrend, it shows that the price decreased up to around this level, but the buyers were able to push the price right back up before the trading period was closed. Okay, so as such, a hammer candlestick in a downtrend suggests potential exertion of the downtrend and an onset of the bullish reversal. So we are saying every time we see a hammer and it happens in a downtrend, it means that the potential exertion of the downtrend has occurred and there is an onset of a bullish reversal. Okay, so the trend is going to change from a downward trend to an upward trend. Okay, so we are saying that when you see the price is in a clear downtrend, okay, and then at the tip of the downtrend, right there, form what we call a hammer. It shows that the pressure which has been pushing the price further down has reduced. Then we expect a new trend to happen, and that is an uptrend. Okay, so when you look at the chart on your screen, you can clearly see that this was a clear downtrend. This was a clear downtrend. The price is decreasing. Yeah, downtrend. The price is decreasing, and then after forming a hammer, right here, hammer was formed. Then the price was able to clear hammer. Okay, it doesn't matter whether it is a green candle or whether it is a red candle. It is still a hammer, and it occurs in a downtrend, and it shows a reversal from a downtrend into an uptrend. So when you look at the chart clearly on your screen, you want to be able to spot some hammers, and did they happen on a place whereby the price changed? Okay, that's what we want to find out on the chart. So when you look at the chart, take some time and look clear. Can you be able to spot some hammers? Of course, you can see that right here we had a clear downtrend. Oh, sorry. So right here we had a clear downtrend, and after the price reaching at the tip, it formed what we call a hammer, and then the price was able to reverse. So the reverse was not that much successful. Again, the price decreased after forming a new hammer right here, we get a big reversal. Okay, so we are looking for another hammer. Here the price, of course, it changed direction, but it was not a hammer, it was something else. Okay, so we are trying to look out for a new hammer. We are seeing here a hammer. Hammer is here, and then the price is expected to reverse. Okay, so every time we form a hammer, of course, we change direction from a bear market into a bull market. Okay, so when you look at this hammer here, its wick is little, the upper wick, and then when you look at this hammer, the upper wick is a little bit longer, and then you look at this hammer, its upper wick is moderate. So we said hammer may have an upper wick, or it may not have a wick. And then the color of the hammer does not matter. So when you look at the chart here, this hammer here is a blue candle, and it shows a bullish momentum. It's a bull candle. So here the color does not matter. This color is also blue, and then here it is blue. But in the previous chart we saw, let's go back a little bit. The previous chart right here, you can be able to see that this was a red candle. Then we are agreeing that in hammers, the color of the candle does not matter. As long as it is hammer on a clear downtrend, it shows change in direction of the market. Okay. So again, we said a hammer has a small body. Okay, has a small body, then it has a long, and then it occurs on a clear downtrend, and then the price passes to an uptrend. So here we have a hammer, then here we have a hammer, then right here we have a hammer. Okay, that is a hammer. So another candlestick pattern, this is what we call the inverted hammer. So the other time we saw a hammer, now we are seeing an inverted hammer. Okay, looks like this. So this is similar to a hammer, though it is inverted. When an inverted hammer appears at the bottom of a downtrend, its long wick implies an successful effort by bears to push the price further down, after corresponding effort by bulls to push the price up quickly. So we are saying we are in a clear downtrend. So you are in a clear downtrend, and then you form an inverted hammer like this one. Okay. So when you form an inverted hammer, it shows that when the price reaches this level, it's the buyers which pushed the price up to that level, and then the sellers try to push the price down. Okay, but this level was failed to be broken. This level was not broken. It shows that the bears have failed to push the price further down, and then we expect a reversal from this downtrend into a clear uptrend, another new uptrend. Okay, so as such, an inverted hammer candlestick in a downtrend suggests potential exhaustion of the downtrend and an onset of a bullish reversal. So when you look at the chart here, we want to be able to spot some inverted hammers. So you look clear on the chart and spot some inverted hammers. So when you look right here, price was decreasing, but did you get an inverted hammer? Of course not. Then right here, still the same thing. The price decreased, and then we formed an inverted hammer right here. Hope that is very clear. And then when we formed this inverted hammer, we got a clear uptrend, which is short term. Okay. So inverted hammer occurs in a downtrend. Okay, an inverted hammer occurs in a downtrend. So for example, when you look at the chart right here, is that an inverted hammer? Of course, this is not an inverted hammer because this is not on a downtrend. So an inverted hammer is right here because this is downtrend. Then you have another one here because this is a downtrend. Okay. So every time we form a hammer on a downtrend, we expect a reversal from the bearish sentiment into a bullish sentiment. Okay. So that is how an inverted hammer is. Okay. So once again, we can be able to spot some inverted hammers. Of course, we have one here, look like an inverted hammer also. Then we have this one, look like an inverted hammer also. And then this one, sorry, this one looks like an inverted hammer, but it's not an inverted hammer because this is not a downtrend. Inverted hammers occur on downtrends. This is an inverted hammer. And then this is also an inverted hammer. Okay, so we continue. So we are going to be looking at a shooting star. So we are going to be looking at a shooting star pattern. Okay, and the shooting star looks like this. So this occurs in an uptrend, and it happens to be the opposite of the inverted hammer. So we have said an inverted hammer occurs in a downtrend, while a shooting star occurs in an uptrend. So when a shooting star appears at the top of an uptrend, its long wick implies an unsuccessful effort by bulls to push the price further up. After their corresponding effort, push the price up quickly. Okay? So as such, shooting star candlestick in an uptrend suggests a potential exhaustion of the uptrend and an onset of a bearish reversal. Okay? So we are saying when you look at the prices moving high, like that, then at the top of the uptrend you form a shooting star. Is the opposite of an inverted. This one shows that the uptrend has exhausted. Then we expect a new, either short term or long term. So when you look at the chart right here on your screen, can you be able to spot some hammers, some shooting stars? So we are looking for a shooting star, and we said it's supposed to be on an uptrend. Of course, the first thing you have to look for is an uptrend, and on the chart right here is a downtrend. So we are not looking for something else. Okay, so right here you can see previously what we looked at. This was our hammer. Okay, so when you look here, this was a clear uptrend. Right here, we have a clear uptrend. Then right here we have a downtrend. Here we have a short-term uptrend. Then here we have a downtrend. So you're looking for a shooting star. So when look here, we have to look for where the uptrend is and where it exhausted from. So the uptrend exhausted from this level. So this is where we get our shooting star. And as soon as we form the shooting star, what's the price down? Okay. So once again, a shooting star happens on an uptrend. When it is formed, the price has to reverse to a downtrend. This is our shooting star, and it is the opposite of an inverted hammer. So it has a body, then it has a long wick, and then the lower wick might be little or okay. So that is a shooting star. So every time you see a shooting star in an uptrend, it shows exhaustion of the uptrend and then an onset of the bearish reversal. So we are going to be looking at another candlestick pattern called the hanging man. So we have the hanging man. Okay, this is how the hanging man looks like. Looks like a hammer, but it's called a hanging man. So the hanging man is identical shape in the hammer. The difference is that while hammers occur in downtrends, hanging man occurs in uptrends. Is that clear? For example, you have a clear trend up, and then you have another clear trend down. So we are saying that hanging man always occurs in the uptrend, okay? That then at the base of the downtrend, get what we call a hammer. So in a downtrend, we get hammer. while in an uptrend we get what we call a hanging man. Okay, so we're saying a hanging man is identical in shape to the hammer. The difference is that while hammers occur in downtrends, hanging man occurs in uptrend. So in this case, the wick extends down, contrary to the uptrend, and suggests the emergency of a bearish demand capable of pushing the price down. It's often the first sign of the uptrend. Exhausting. Players are stepping in to create a reversal. Okay. So when look here, price was moving high, formed a hanging man, then the price burst. That is hanging man. So when look at the chart right here, can we be able to spot a hanging man? So the first thing we have to look for is a clear uptrend, and here the price was formed an uptrend, and then it on its tip formed the hanging man, then the price down. Okay, here the price went up. Okay, formed the candlestick pattern right here. This looked like a hanging man right here. This red candle, and then the price went down. Okay, so it's a downtrend. We don't look for hanging man. And the price here was moving up. Okay, it formed the hanging man, this red candle here, and then the price dipped down. Okay, so once again, a hanging man occurs in an uptrend, and after it is formed, we get a downtrend. That is a hanging man. Once again, when we look at the chart, we say that a hanging man occurs in an uptrend, and after the hanging man is formed, we get a downtrend. So right here, we formed a hanging man, and then the price reversed. Okay, this red candle here is a hanging man, and the price reversed. Then right here, we had formed a hanging man, but it was not so clear. Okay, we have a clear hanging man, then the price. Okay. So we are going to be looking at a shooting star, and a shooting star looks exactly like this. Okay, and this candlestick simply the opposite of a hanging man, and it has a small body and a long wick. Okay, protruding above it with little or no wick. The shooting star occurs at the height of an uptrend. Its long wick implies that resistance to further bullish movement and bearish reversal is set in. Okay, that is a shooting star. They are saying that a shooting star is simply the opposite of a hanging man. It has a small body and long wick protruding above it with little to no wick below. The shooting star occurs at the height of an uptrend. Its long wick implies that resistance to further bullish movement and bearish reversal may set in. Okay. So when we look at the chart here, we want to spot some shooting stars. Okay. So we have to first look for a clear uptrend. Then we look for a shooting star. For example, here the price was moving high, and then we get a shooting star here. After getting a shooting star, of course, the price dips. So again, we look for a clear uptrend. Then do we get a shooting star anywhere here? Of course, no shooting star. But right here, the price was moving high, and then we get a clear shooting star here. Then the price burst. Okay, so a shooting star, number one thing, it occurs in an uptrend, and then after it has been formed, we expect a reversal from the uptrend to a downtrend. Okay, so right here, you have no shooting star. So the price tried to reverse, and it was not successful. So another candlestick pattern we're going to be looking at is what we call the evening star. Okay, the evening star is a 3-bar pattern that can provide an early indication of a reversal from bullish to a bearish trend. So the pattern represents a potential top, therefore a potential signal to sell. These are characteristics of 3 candles. Okay, so an evening star is a 3-candle pattern that can provide an indication of a reversal from a bullish to a bearish trend, and then the pattern represents a potential top and therefore a potential signal to sell. Okay, these are the characteristics of the 3 candles, or which occur in a shooting star. Number 1, you see the star. Okay, the candle which forms last as number 3, and then we have a gap then gap up, and then gap down. Okay, so we are saying that when you are forming a shooting star, of course, it is occurring in uptrend. Okay, so what happens in an uptrend? You get a very big bullish candle. After bullish candle closes, you get a gap. Okay, to form a new candle. So at the formation of this candle, which is in most cases small, you form another gap going down, and then you form a big bearish candle. There you form what we call a shooting star. So for example, and look here, we have series of bullish candles, price is moving high, and then it forms a gap, then it forms a small candle at the tip, and then it forms a new gap, and then followed by a big bearish candle, and then the price reversed. So a free candle pattern, what we call the shooting star. This candle, then this candle is what we call the shooting star. Okay, so it has to occur in an uptrend. We have to see a bullish candle first, right here, and then you have to see a gap up, is right here, and then you have to see a bearish or a bullish candle, which is small, okay, which is here, and then you have to see a gap down, which is right here, then you have to see a bearish candle, which is here. So from there, we expect the market to reverse downward. So that is our evening star. So when you look at the chart right here on your screen, can you be able to spot some evening stars? Number one, you have to look for an uptrend. So when you look right here, this is the reversal, it's on an uptrend. But when you look right here, this is a big reversal and it shows a short-term uptrend. So when you look at this short-term uptrend, okay, we formed a long candle, is bullish right here. Okay, we have a big candle, we have a small gap, we have a small gap followed by a bearish candle. So there we form what we call the evening star. So sometimes it is not as perfect as it is told in papers, but it looked full like an evening star. Yeah. So for example, when you look here, this is more characteristic of an evening star also, though it did not happen on their uptrend right here. So when you zoom in the chart, you could be able to see it clearly. Okay. So it happened in an uptrend. After it has been formed, the price has to reverse down. Cases. So another pattern we are going to be looking at is called the morning star. So the morning star is a variable pattern that can provide an indication of a reversal from a bearish to a bullish trend. So the pattern represents a potential bottom and therefore a potential signal to buy. So these are the characteristics of the three candles in the morning star. Okay. So number one, it has to be a clear downtrend. Then we form a bearish candle. Then we form a gap down. Then we form a bullish candle. Then get a gap up, then followed by a bearish candle. Okay. So we are saying that in a clear downtrend, okay, we shall get a big candle, which could be a bear candle. Then after there, we get a gap down, okay, followed by small candle, which is bullish or bearish, followed by a gap up, then followed by a clear bullish candle. So from there, we get a signal to buy or a signal to change trend from a downtrend to an uptrend. Okay, that is a morning star pattern. It's the opposite of the evening star. So when you look at this chart, can we be able to spot a morning star? Of course, number one thing you have to look for in a morning star is to look for a clear downtrend, and then it forms. Then after forming, it forms an uptrend. Okay, so when you look here, there's a clear downtrend. So we are going to be able to spot a morning star within this base of the. Okay, so when you look here, we formed the evening star. Okay, right here we formed evening star. So we have a bear candle, we have a gap, we have a small candle, which is incision, then we get a big bullish candle. So we form what we call an evening star pattern. Okay. And then another one would potentially be right here. Then it shows successful change in trend because the preceding year was bear market. Okay. So you have that one. Then we have another one here. So in most cases, due to liquidity, the gaps are very minimal. Okay. Wow. So another candlestick pattern we're going to be looking at is the bullish engulfing pattern. So this pattern, the real body of the bearish candle, that's the range from open to close, is encompassed by the body of the consequent bullish candle. Okay. So we are saying that in a bullish engulfing pattern, the real body of a bearish candle is encompassed by the body of the consequent bullish candle. Okay. So what happened is that you get a bear candle, which is in a downtrend, and then it is followed by big candle, which covers the entire body. So this candle, which forms the bullish candle, it covers the entire body of the previous bearish candle. Okay, this is what we call the bullish engulfing. In other words, it engulfs the previous candle. Okay, so when you look here, there's a series of downtrend of their candles. And then after this candle was formed, okay, it was followed by a bullish candle which covered its entire body, and that is what we call the bullish engulfing. So this is something right here. It's what we call a bullish engulfing. It's a bearish candle followed by a bullish candle which covers its entire body, and then there's something right here. Okay, and then there's something. So this indicates an increase in activity from both bears and the bulls, and a shift of the overall market sentiment towards the bullishness. Okay, so this pattern should be viewed in consideration of the trend at the time. If bullish engulfing pattern appears in a downtrend, it can suggest a change in trend and the onset of the buying demand, becoming prevailing force that will ultimately push the price higher. Okay, so we are saying the pattern should be viewed in consideration of the trend at the time. Okay, and if a bullish engulfing pattern appears in a downtrend, it can suggest a change in trend and the onset of a buying demand become the prevailing force that will ultimately push the price higher. Okay. So when you look at the chart right here on the screen, can we be able to spot some bullish engulfing patterns? Of course, we said it normally occurs in a downtrend, and then a subsequent candle covers the candle which is previous, and then we get an uptrend. For example, here we got a bullish engulfing pattern, though the change in trend was not successful. Okay, so a bullish engulfing, of course, we have one here. The price contained in the major trend. Then we have this one here, a bullish engulfing. Then we have another one here, a bullish engulfing pattern also. Okay, where else can we see a bullish engulfing pattern? We can see this one maybe as a bullish engulfing. I think that's all. We have this one, it's one of a bullish engulfing pattern also. So normally consider them in a downtrend. So we have a bullish engulfing, the price keeps going higher. A bullish engulfing, price keeps higher. Bullish engulfing, price keeps going higher. Then here we have a bullish engulfing, price goes high. Then you have here bullish engulfing, we just expect the price to get higher. Okay, so here we got a bullish engulfing, but it was followed by a shooting star, which shows a change in trend from the bullish market, which has been taken over to bear market. Okay. So here we have two consequent candlestick patterns. We have this one, which is a bullish engulfing, and did not succeed because it occurred at the tip of the uptrend. but then it was followed by what we call a shooting star, which is also a clear candlestick pattern which shows change in trend from uptrend to downtrend. So we have a bullish engulfing again right here. It's a two candlestick pattern. Then we have another bullish engulfing right here. We have another bullish engulfing right here. Then you have a bullish engulfing right here. And then you have a bullish engulfing right. So we're going to be looking at a bearish engulfing pattern. Of course, this pattern, the body of the bullish candle is encompassed by the body of the consequent bearish candle. And this indicates an increase in activity from both bears and bulls and a shift from market sentiment towards the bearishness. So we're seeing that the price is going high. Then the previous bullish candle is covered up by a candle fully. This one forms a. Then, for example, look here, price was moving nicely up. Then after this subsequent candle was covered by the coming candle, its body was totally covered up by this candle. And then we got a downtrend. So bearish engulfing pattern is most indicative of onset of a bearish price move when it appears in the midst of an uptrend. Okay. So when look at the chart right here, can we be able to spot some bearish engulfing patterns? Of course, number one thing you have to look for an uptrend. Then after seeing an uptrend, of course, we get what we call a bearish engulfing. So irrespective of the trend, we can be able to spot bearish engulfing right here. Then the price tends to move down. Okay. So when look here, there's also a bearish engulfing, though the price did not succeed going downwards after forming these other candlestick patterns. Okay. So we also have a bearish engulfing right here, and it showed some subsequent move downwards. Okay. So we want to look for a bearish engulfing, which is so clear, and then the price moved downwards. Bearish engulfing. Can you spot this? Okay. A bearish engulfing, the price went down. Then we have here a bearish engulfing, price went down. So it's not that this is not a bearish engulfing pattern, okay? Because the candle does not cover its entire body, okay? But here we have a bearish engulfing pattern. The bearish engulfing occurs in an uptrend and it shows change to bear market. Then a bullish engulfing occurs in downtrend and shows change to a bull market, okay? So once again, you have a bearish engulfing right there. We have a bearish engulfing right there. We have a bearish engulfing right here. We have a bearish engulfing right here. We have a bearish engulfing right here. And then this one. So we expect the market to go down. All goes well. Okay. So another candlestick pattern we are going to be looking at is what we call the three white soldiers. So this is the three candle bullish pattern that implies a reversal at the bottom of the bearish trend. Okay. So we are saying it's a three candle bullish pattern that implies a reversal at the bottom of a bearish trend. Okay. So we are saying the price is nicely forming a downtrend. Okay. And then it is followed up by a series of bullish candles. Which are three in number. Okay. Then you form a pattern. That is what we call a three white soldier candlestick pattern. So it is a clear downtrend. Then you form series of three bullish candles. So these are what we call the three white soldiers. Okay. So the three white soldiers are bullish candlesticks that open within the body of the previous candlestick and close near the high of the day. Okay. So this implies that to all three candles, they should be strong bullish candles with small wicks and close near the top. The high closes imply strong reversal from bearish to a bullish market sentiment. Okay, so we are saying that you see a clear downtrend, of course, then you form series of bullish candles which close higher. Okay, that's one. This is what we call the three white soldiers. Okay, and then they show a change from a bear market to a bull market. So we said that a bear market is a downtrend, and then a bull market is an uptrend. So when you look at the chart right on your screen, can you be able to spot some three white soldiers? Number one thing you have to look for is a clear downtrend, then you spot the three white soldiers. So when you look here from the three white soldiers, 1, 2, 3 bullish candles. Okay, they tried to be resisted later on, but the price finally went up. And then again, here we have a clear downtrend. And then at its base here, we form what we call the three white soldiers right here. And then the price went higher. Okay, that is the three white soldiers candlestick pattern. It shows change from a downtrend to an uptrend. Three white soldiers right there, three white soldiers right there. They are all strong bullish candles. Okay, and then they show a change in trend from downtrend to uptrend. So we are going to be looking at another candlestick pattern called the three black crows. This is a three candle bullish pattern that implies a reversal at the top of the bullish trend. Okay, so the three crows are bearish candlesticks that open within the body of the previous candlestick and close near the low of the day. So they may signify a trend change from bullish to bearish. Okay, so the opposite of three white soldiers is three dark crows. So we have a clear uptrend, and then we have series of red candles, which are bear candles. Then they confound as three black crows, which show a change in trend. Okay. So when you look at the chart, can you be able to spot some three black crows? Number one thing you have to look for a clear uptrend. For example, right here is a clear uptrend followed by a series of three bearish candles. That is what called a three black crows. So when you look here, it is also a clear uptrend followed by series. So this one here was known as three black crows because of this candle which formed. This is not a bearish candle, so this is not three black crows. But right here, then the price. Okay. So still, when you look here, it was a clear uptrend followed by three candles, bearish. That is a three black crows. Then after there, the price went down. So here the price was trying to reverse, but after these strong moves, price got a little lower. Okay. Those are three black crows. So another candlestick pattern we're going to look at is the bottom. So these two candlestick reversal patterns appear at the bottom of a downtrend. And these candles share either a high or a low that represent movements in opposite market directions. So the tweezer bottom is where an initial bearish candlestick continues in a downtrend, closing at or near the low, which then becomes the low price of subsequent bullish candlesticks. So we are saying a tweezer bottom is a initial bearish candlestick and continues in a downtrend, closing at or at a low or near a new low, which then becomes the low price of consequent bullish candlesticks. So tweezers indicate that once price reached a significant level, okay, there was a force that transferred dominance between bears and bulls. It is similar to the piercing line or the dark cloud cover that is covered later in this video. Okay, so we are saying that the tweezer bottom, just like the word signifies, it is bottom. So the tweezer bottom occurs in a downtrend. Okay, so it is a series of downtrend. So the price is in a clear downtrend. And then at this downtrend, we form two candles. So for example, you have a bearish candle is in this format, and then it is followed by a subsequent bullish candle, which is similar with the same bodies. Okay, the wicks can be all up, or they can be this format. One with a wick going up, a wick going down. So those they are all tweezers. So in most cases, they share the same body. The bodies are normally equal. Okay, that's what the tweezer bottom. Okay, and when you see a tweezer bottom in a downtrend, it shows a change in trend from a downtrend to an uptrend. So when you look at the chart right here, of course, can you be able to spot some tweezers? So when you look at the chart, the number one thing you have to look for is they happen in a downtrend. Okay. So for example, when you look at the price was moving down, it formed these two candles here. This is what we call the tweezer bottom. The candles share the same body, though the wicks are not similar. Okay, but it still remains a tweezer. Okay. So after forming these tweezers, of course, the price got higher. Okay. Can we be able to spot some of the tweezers on this chart? Of course, here you have some tweezers, though they're not so clear. Looking for tweezers. Of course, here we have a tweezer bottom. So the price is in a clear downtrend, okay, right there. And then you form these candles here, which share similar bodies. These are the tweezers, okay. Another tweezer, we have this one here. Irrespective of the wicks, okay, they share the same bodies. They're all equal bodies. Okay? You can see, so we expect a change in trend and uptrend. So we are saying that tweezers always open in a downtrend, the tweezer bottom, and then they normally share the same bodies. So sometimes the wicks might be similar, or the wicks might appear in different direction, and then it is followed by a new change trend. Okay, that is a tweezer bottom. Wow. So the opposite of tweezer bottom is of course tweezer top. Okay, so these two candlestick reversal patterns appear at the top of an uptrend, and the candles share either a high or a low, but represent movements in opposite market directions. So tweezer top is an initial bullish candlestick, continues in an uptrend, closing at or near a new high, which then becomes a higher price of the consequent bearish candle. So this does indicate once price reaches a significant level, of course, there was a transfer of the dominance between bears and bulls. It is similar to the piercing line and then the dark cloud patterns, which shall be covered later. Okay. So we are saying for the tweezer top, they happen in an uptrend, and after forming tweezer tops, we get a downtrend. So when you have a clear uptrend like this, we normally get candles which have similar bodies. So they might have the same wicks, okay? And then after formation of those candles, we get change in trend from a downtrend to, from an uptrend to a downtrend. That is what we call the tweezer top, okay? So occurs in an uptrend. When it is formed, you change a trend from bullish to bearish. So when you look at the chart on your screen, can you be able to spot some tweezers? Of course, this is not a tweezer top. This is a bearish engulfing pattern. So we are going to look for a tweezer. So tweezer top, we have to look for a clear uptrend, and then we start to look for a reversal. So right here, the price was moving high. We formed these two similar candles, the same bodies. So their wicks are in opposite directions. So that is a tweezer top, and then price dropped. Okay. So we also have a tweezer top right here. Okay. There's a tweezer top. Where else can we see a tweezer top? Tweezer top. Nowhere. This is not a tweezer top. So here you can see the tweezer top. Then right here, this is a more clear. So the bodies can be in this format. Or you can have this format. Or you can have this format. Similar bodies, similar wicks also. Okay. As long as they happen on an uptrend, they all remain valid tweezer tops. Okay. The colors do not. So another candlestick pattern we're going to be looking at is what we call the checkmate. Okay, it's called a checkmate. So checkmates occur when price becomes locked in a narrow trading range, preceding a reversal in direction. Okay, so a bearish checkmate, an uptrend, meets resistance level that is tested. In this case, the checkmate begins as the first candle in the range reaches a high that the pressure from bulls is unable to surpass. Okay, price remains locked in a trading range before the range is broken with a long bearish candlestick, indicating the reversal in trend. Okay, so we are saying that we get a clear uptrend. After getting this clear uptrend, of course, so when the checkmate begins when this candle here, which is on the top of the uptrend, it forms a new high, which the preceding candles or which the candles that come later fail to break. So the price starts to remain in range. Okay, so the price will start to get locked in this range. So after the price is locked in a change, so after the price is locked in a so when the price is locked in so after this preceding candle is formed, we will form a range. This is whereby the price fails to break the previous highs. Then after that range, then we form a big bearish candle. Okay, so after this big bearish candle, we get a new signal to form a downtrend. Okay, so when you look at the chart here, price is moving high. Okay, and then after there, these candles get locked into a trading range. Okay, then followed by big bearish candle. That is what we call the bearish checkmate. So a bearish checkmate was in an uptrend. So in a bullish checkmate, a downtrend meets a support level that is tested. And in this case, the checkmate begins as the first candle in the range reaches a low. The pressure from buyers is unable to break or surpass. So price remains locked in a trading range before the range is broken with a long bullish candle, indicating that the reversal has begun. Okay, so we get series of downtrend. Okay, and then the price gets locked in a range. And then we get a preceding bullish candle. Okay, that is what we call the bullish checkmate. So it's saying that the price is in a clear downtrend. Okay, after there, the price gets in a range. After this range is formed, we form a clear big bullish candle, signifies a bullish checkmate, and then the price reverses. Okay, so when look at this chart, can we be able to spot some checkmates? Of course, we can be able to see that this was a downtrend, but it preceded with a long uptrend, but not with a bullish checkmate, but with what we call a bullish engulfing pattern right there. So here we got a bear market is small, and then here we formed what we call trading range, followed by a big bull candle. Then the price proceeded upwards. So there we formed what we call a bullish checkmate. So this was a downtrend. Okay. After this downtrend, the price got locked in a range. After that range, we formed what we call a long bull candle, which signifies that the previous one was a checkmate. So from here, the price went higher. This art we call a bullish checkmate. Okay. So in a bearish checkmate, you can see that here the price was moving high. Okay. And then here it created a trading range, which was preceded by a long bear candle. Then the price down. They have formed what we call a bearish checkmate. The price goes high, presses a bit, and then goes high, forms a range. The range was broken by big bear candle. Then we formed a new downtrend. That is what we call the bearish checkmate. Okay, so this is where the sell is from right here, then catching the wave down. So another candlestick pattern to look at is what we call the Harami or the inside bar. Okay, Harami or inside bar. So this pattern is a two candlestick pattern in which the first candle stick vertically encompasses the one that follow is. Okay, so the Harami or inside bar can be indicative of exhaustion or an onset of a reversal. In this manner, it is similar to a long wake pattern and evening star or morning star patterns examined in this slide later. Okay, so we are saying for a Harami, you get a big candle, then this big candle is engulfing the preceding candle. Okay, that is what we call the Harami. So as you can see here, a clear downtrend, the big bullish, sorry, a big bearish candle, which is engulfing this candle which was formed next. That is why it is called an inside bar, and it is a signal that we are going to change a trend. So in an uptrend, you get a bullish candle which is big, okay, and it is followed by a bearish candle whose body is covered by the previous bullish candle. It is a signal that the price is going to go down. Okay, big candle. Then the candle which is formed next is covered by the previous candle. That's what we call Harami or side. Okay. So here, bullish Harami occurs in a downtrend, then a bearish Harami occurs in an uptrend. So we are saying that price goes down, then you form a bullish Harami, then the price goes high. The price is going upwards, form a bearish Harami, then the price goes downward. Okay. So when look at the chart right here, and we be able to spot some sidebar or Harami. So we are saying that the previous candle should be engulfing the candle that precedes it. So we are going to look for one in the downtrend as a bearish Harami, then one in an uptrend is called a bullish Harami. So when you look here, there an Harami? Of course, no. So when you look here, was there an Harami? Of course, we have this one. We have this one here. So you can clearly see that this previous bearish candle, which occurred in a downtrend, was covering this bullish candle. Okay, that is what we call a bullish Harami. Okay, so when you look here, price was trying to go high, but this previous candle was covering this new candle which was formed in the bearish candle. Then the price went down. That is a bearish Harami. So the same thing happens here. This previous bullish candle encompasses the bearish candle that precedes it, and then the price goes downward. The same thing right here. That's on the sidebar. So where else? Nowhere can we see Harami. Was nowhere. So we have one here. That's a bullish Harami. Bullish Harami. We have this is a bearish Harami. Then you have this is a very clear bullish Harami. Okay, that is the Harami. So we are going to be looking at pin bars. Okay, so these are similar to hammers and shooting stars. They therefore have similar market implications. So a bullish pin bar occurs in a downtrend and shows a possible market reversal into an uptrend. Then a bearish pin bar occurs in an uptrend and shows a possible market reversal into a downtrend. Okay, so the color of the candle does not matter in pin bars. Okay, so here we have pin bar, pin bar. It can be bullish or bearish, irrespective of the color. And then the similar thing here. So the only difference we are seeing that a bearish pin bar, okay, has a long wick apple. The basic difference we are seeing is that a bearish pin bar has a long upper shadow, okay, and then a bullish pin bar has a long lower shadow. So the same thing right here. Bearish pin bars have long upper shadows, while bullish pin bars have they have longer lower shadows. So when you look at the chart, can we be able to spot some pin bars? Of course, we said that for a bearish pin bar, it has long upper shadows. And then for a bullish pin bar has a long lower shadow. So we end with a long upper shadow. It's a bearish pin bar. Every time it is formed, the price will change. For example, right here, we got what we call a bearish pin bar. Then the price went downwards. Then when we look at this one, it's a bullish pin bar. Every time we see it, we expect a reversal to an uptrend. And of course, we got them right here, two of them. Then the price went right up. Color does not matter. This is also a pin bar, or it can be called a hammer. And then here we have some pin bars also. Oh, they're not so clear. Okay. So here we have your bearish pin bar, price goes down. Okay. Then here we have some bullish pin bars, then the price goes up. So we've got a bullish pin bar, then the price goes up. Okay. So we are going to look at a kicker as the next candlestick pattern. A kicker signal, also known as a professional gap, occurs when the price following conditions are met. Number one, price is moving in a trend. Number two, suddenly a gap appears in the chart. So a gap is defined when the open price of one candle is not equal to the close price of the candle that precedes it. There is a gap in the price movement, and the gap is in the opposite direction of the trend. For example, you have a downtrend, okay? And then you have a candlestick, this last candlestick that was formed in that trading period, and then the next candle creates a gap, then opens, creates a gap, then opens a little higher than the previous closing price. So for example, if this candle closed at $3 per share, then this candle here opens at $5. So it has created a gap of 2. Instead of opening at 3, it opens at 5. So that is what we call a gap. Okay. So for instance, imagine a price closed at 10 after running over a number of days from 2. Okay. So you're seeing the price moves from 2, goes high, then it closes at $10. So the price opens at 8 later on. So then the price opens 8. Instead of opening at this 10, which was the closing price, the price opens at 8. So that is a gap down. Okay. So in this instance, we have a gap down. And that is what we call the bearish kicker. So conversely, the price opens from 10 to 3, and then open the next day at 5. it would signal bullish kicker. A bullish signal for traders, a kicker signal can be a very powerful signal that a trend is reversing. It is often interpreted as a sign that professional investors have quickly realized a trend is over and are looking to get out of the trade immediately. So as such, this signal often precipitates a rapid reversal of the prior trend. Okay. So this is how the kickers look like. So here we have a bullish kicker. So we say that the price closes around here. So for example, if it closed at $10 per share and then opening of the previous candle, this is a bearish candle, it closed lower at around $10. Then this one opens at around let me say 12. Instead of opening at a 10, which is the previous trading price, it opens at 12. Of course, it creates a gap. This candle which is formed after creating a gap is what we call a bullish kicker. So a bearish kicker right here is formed after creating a gap from the previous bullish candle. Okay, so for example, this candle closed at 10. Instead of this candle opening at 10, it's at 8. Creates a gap of 2 and then what we call a bearish kicker. Okay. So for example, when you look at the chart here, can we be able to spot some kickers? Of course. When you look at the downtrend right here, this candle here closed low, and then it was preceded by a gap, and then this candle opened from here. So this is what we call the bullish kicker. Okay. So the same thing right there. This candle opened high, but this previous candle did not open at that price. This is what we call the bearish kicker. So here, this candle closes low and opens high, comes a bullish kicker, price goes high. Okay. So in a downtrend, here we have a bullish kicker. Then we have a bullish kicker also. Okay. Can we spot a bearish kicker? No bearish kicker right here. For example, this gap here help us to spot a kicker. So it's not in an uptrend. So that's not a kicker. This one, downtrend. Okay. We form a candle, a gap, that is a bullish kicker. So even here you created a gap. This is a bullish kicker. But this one here, bearish kicker, so the preceding pressure is not enough to push the price further low. Okay. So we have another candlestick pattern called the piercing line. Piercing line. Okay. So a bullish signal, piercing line is a bullish signal that occurs in a downtrend, where after a long bearish candle, bullish candle opens at a new low and then closes at a level at least halfway up the body of the previous bar. So this is similar to a tweezer pattern, which we discussed later in the guide. Okay, so we are saying that we have a clear downtrend, and then we have a bearish candle, and then the preceding candle or the next candle. This is where the price closed from. So we expect the next one open from this price, but it does not open from there, but it opens lower than that price. Then this candle here opens, closes at least halfway of the previous bearish candle. That one is what we call the piercing line pattern. And then it is a bullish pattern. So every time we see it, we expect a change in the market trend. So for example, here, the price was moving downwards, and then we formed bullish piercing line. Okay. And then the price reversed. So we have a dark cloud cover as a next candlestick pattern. dark cloud cover. So dark cloud cover is the opposite of the other one. So this is a 2 candlestick bearish pattern and is the opposite of piercing line. It occurs at the top of a bullish trend. So the first candle is followed by a bearish candle that opens at a new high, then closes at least halfway down the body of the candle preceding it. Okay, so this pattern is mathematically similar to piercing line and Tweezer pattern. So we're saying that the price is moving high. It then forms a bullish candle. Okay, so the bullish candle closes here. So instead of the bear candle opening this price, it opens a little high, but then it finally closes at least halfway of the previous candle. That is what we call a dark cloud cover. So it happened right here, for example, in this chart. So the price, the candle closes, this one opens a little higher, and it closes at least halfway of this previous candle, and the price moves. Okay, so that's a dark cloud cover. So this has come to the end of this video, but I want to add you one thing. There's what we call the confluence. So in technical analysis, there is no such a thing as a sure bet or holy grail or sure deal. Of course, candlestick patterns are not the holy grails of forex trading. Okay. The nature of trading securities is that the possibility of profit comes hand in hand with the possibility of risk. Okay. So every time you see a trading a profit possibility, there is also a losing possibility. Okay. So with this uncertainty in mind, the successful application of technical analysis depends on entering the market at a moment when there are many indicators of an advantageous outcome as possible. Okay. So this concept is called what we call the confluence. So the idea is that the best market moves are those that are supported by multiple converging factors or indicators that all testify the advantageous conditions of the trade. Okay, so we are saying when you get a trade, for example, an uptrend, okay, so at the top of this uptrend, you get a bearish. For example, you get a bearish candlestick pattern. So you expect the price to reverse. You take the trade? Of course, no. Why? You have to look for confluence.